Well, good afternoon, everybody, and thank you for joining us today. My name is Mike Deverell, and I'm Partner and Investment Manager at Equilibrium. And today I'm delighted to be joined by Steve Eisman, who is a Senior Portfolio Manager at the Eisman Group, part of Neuberger Berman. And amongst other things, Steve runs what we would describe as an alternative equity fund. It differs from a traditional equity fund that can only benefit from stocks going up, because it can also benefit, it can bet on stocks to go down, which we call going short. And Steve is well known for, back in 2007, 2008, he spotted what was happening in the US housing market and the financial system as a whole. And his story was featured in a book called The Big Short. And that was subsequently turned into a fantastic Hollywood film that I'm sure many of you have seen. So today I want to ask Steve all about his views on the markets and the financial system as a whole. You know, is it still vulnerable to financial crises, or is it much safer than it has been in the past? And also on markets, you know, where are the opportunities? What's he currently really positive on? And is there anywhere particular that he's currently short? And then later on, we'll talk about what happened in the financial crisis and perhaps just touch on his portrayal in that film. So we think the conversation will take somewhere around the region of half an hour, certainly no more than 45 minutes. And we want to hear from you. So please could you hit the Q&A button on your screens at any time, and we'll try and answer as many questions. We'll put those questions to Steve before the end of today's proceedings. So Steve is joining us today from New York, so hopefully the technology will hold up. So good afternoon, or rather good morning, Steve.
Good morning.
Good morning. So just before we get into the financial stuff, I'm just interested on what it's been like in New York over the past few months. Here in the UK, we've been on lockdown since March. We're starting to see a few things reopen. We've got a few shops getting back to opening again, but bars and restaurants are still a way away, and we're all still working from home. So what's it currently like in New York? What are you allowed to do? What are you not allowed to do at the moment?
Well, the city really is just beginning to reopen. Restaurants are not open. Most stores are not open. We're still, I would say, largely in lockdown. I think in a few weeks, you'll see restaurants open where you can eat outside. But the city is quite eerie right now in that it's largely empty. And since the protests have started, many of the stores in New York have been boarded up.
Right. Interesting. So you still, I think you're still working from home. What's it been like, you know, managing money from home during this period?
Well, surprisingly, if I had to pick a business that's least impacted by the pandemic, it would be money management. You know, I have in my home two screens, which is what I have in my office. I have a computer. I talk to people on the phone. You know, so instead of having meetings physically, we just have meetings on the phone. Other than that, everything is more or less the same.
Yeah. It's interesting. Similar thing here, actually. We've all been, working from home, and it's gone surprisingly smoothly. Okay, so before we talk about sort of any specific stocks or sectors, I'm just interested to get your views on the market as a whole. You know, stock market has rebounded pretty strongly from those lows back in March. Do you think that can continue? And your fund can actually go both long or short the market.
Yes.
Are you currently long? Are you currently short? Do you think it's going to go up? Or?
Right now we are about 65% net long, maybe a little bit lower, and that's about as long as we're allowed to be.
Right.
I would say there are, in terms of fundamentals, there are pockets of strength. Real fundamental strength. So for example, I had a thesis. We've owned Lennar for a long time. And when the market bottomed, I had a thesis which I basically went like this, that when 9/11 happened, I remember a whole bunch of people that I knew moved out of the city. They just freaked out. And I thought, maybe you'll have something similar, but it'll happen all over the country, where people, especially young people, want to get out of the cities into the suburbs where there's more ability to social distance. And jokingly, I said to one of my partners, but we won't know that till the fall.
Yeah.
Well, we know already. Housing has rebounded enormously. Orders as in June nationwide are up probably 20 to 30% year over year. That's how strong new home sales are. So there are pockets of strength. There are a couple of ways to play that. We own, like I said, Lennar. We had a recent stock called Zillow. But outside of housing, the economy, I think is still very, very weak. So what explains the enormous rally is really the move by central banks to provide free money all over the world. It's a free money. It's a license to speculate. And as long as that free money is around, unless we get a second wave, I think people are going to continue to speculate.
Well, I was going to ask you about that because obviously that's partly because of quantitative easing. And, interest rates at rock bottom levels all around the world. And that QE, that quantitative easing, is keeping those bond yields really, really low as well. So is it almost like there's basically no alternative but to go for the stock market if you get in search of returns?
I think it's part of it. I also think what we learned from the prior QEs is that very little of quantitative easing actually finds its way into the real economy, which is the mistake of QE. I think the Fed has made the same mistake it made last time. It should have been spending a lot more time working on these middle market lending programs, which would have found their way into the real economy.
Yeah.
Why the Fed decided 2 days ago to buy individual corporate bonds, when over $1 trillion of corporate debt has been raised in the last 3 months, I find bewildering. But it's not up to me.
Yeah.
So I think that money is just going to find its way into the stock market like it did last time.
So, maybe they would have been better off doing kind of helicopter money and giving it to ordinary people. It just finds its way into people's portfolios.
They have a program that's designed for that. They just set up a program to lend to middle market companies. That thing hasn't even been launched yet. So why are you buying corporate bonds when you should be focusing your time on something that will have a real impact? Like I said, it's beyond me, but it's also not up to me. So I think this money is just going to find its way into the stock market. Let me just add one other thing. There's a new phenomenon. Things happen and you don't realize the full implications of them until later. So if your clients might remember, I don't know what the story is in the UK. I don't think this is true in the UK, but in the US, at some time last year, Schwab announced that they were eliminating commissions.
Yeah.
So if you wanted to trade through Schwab, it cost nothing. Now, that was followed by all the e-brokers.
So we've got Robinhood and the like.
And Robinhood, but everybody basically followed Robinhood. Now, what has happened is we've always had institutional day traders. We've never had retail day traders of this size. And now they number in the hundreds of thousands because, you could make a trade in the morning, free, and you could sell it in the afternoon, free. And so I think that has contributed enormously to the volatility as people, and also apparently I read that a lot of these day traders normally would bet on sports, but since there's no sports, they're literally treating the stock market like it's a sporting event.
Well, we've seen a great big rally in the stock price of Hertz, which has essentially just gone bust. And since
it hasn't just gone bust. It went bust.
Yeah.
which normally means that the equity is worthless.
Yeah.
That's how it works. Instead, the stock went up 300% and they raised equity. I mean, it's crazy.
Well, that's what I was going to ask. So, is it crazy? So if let's say you're, rather than a retail investor, but you're a fundamental investor and you're looking at the stock price, normally you'd be looking at what a company's earnings, its profits would be today, what they might be in 12 months' time. But we know that in 12 months' time, for a vast majority of companies, their profits are probably going to be lower over the next 12 months than they were a year ago, for example.
Correct.
So everybody's looking kind of 2-3 years out. And obviously, the longer you go out, it's even harder to forecast. So do you think it's a real risk of a bit of that kind of exuberance, that kind of bubbles might be being blown in a way?
I do think we have a chance for this to look a little, I don't know if people remember, in 1999, you had what I call the market that became bubblicious.
Yeah.
And the reason that happened was in 1998, you had the long-term capital crisis and the Fed cut rates I forget how much they cut rates. They cut them to 1%, which back then was zero, considered to be. So zero is the new normal. One used to be zero. And that gave people the license to speculate on everything. And we had the internet bubble, et cetera, et cetera. And then eventually the Fed raised rates and killed it. But since the Fed has basically said they're not going to raise rates until only like 2022 or 2023, the license to speculate may run rampant. We'll have to see. I mean, I think the only thing that could break this as of now would be a real resurgence in the pandemic.
Yeah.
And or Joe Biden becomes president and both houses of Congress go Democratic, and therefore tax rates, without question, would go up.
Yeah. Just on that, one other thing we hear anecdotally is fund managers generally and investors as a whole. A lot of them still have a lot of cash in portfolios. They've got cash on the sidelines, and a lot of people kind of miss the market rally. So could that are there a lot of people out there, in your opinion, sort of just waiting to buy the dip, and could that constrain any further down?
They're waiting to buy the dip. And then unfortunately, when the dip happens, they don't buy because things are so precarious. I mean, let's all admit, things are very precarious. None of us have had any experience with the pandemic. There's nothing to analogize it to. Mm-hmm. So it makes, in some ways, it difficult to jump in, especially when you start to see resurgences going around.
Yeah, absolutely. No. Okay, well, let's talk about the financial system as a whole, because back in those lows in March, a lot of people were quite worried, and it felt like a number of indicators of financial stress had reached kind of similar to 2008 kind of levels. A lot of people said that, certainly liquidity in the markets had dried up. So how resilient do you think the financial and the banking system is today? Is there a chance that something like this pandemic could trigger another financial crisis, or is it a bit more resilient?
So let's separate banks from the fixed income markets. And let's go back to 2008. So in 2008, the banks failed and the bond markets failed. And the system came in and basically bailed out the banks by giving them a massive infusion of capital, and bailed out the bond markets by guaranteeing money market funds, et cetera, et cetera, et cetera. This time around, I'll just focus first on the United States, and we can talk about Europe in a minute. In the United States, over that period of time, since the financial crisis, the banks have delevered enormously. So Citigroup used to be levered, for example, 33 to 1. And as of just before the pandemic, they were levered 12 to 1. Which, in my world, I mean, for your clients, that may not mean a lot. Obviously 12 is less than 33. But in my world, that's like the distance from Mercury to Pluto.
Yeah.
So I have said publicly many times that I thought the financial system in terms of the banks was safe.
Yeah.
And, for example, when the pandemic started, one of the worries was that companies would pull their lines. And the question is, would the banks have enough liquidity to fulfill those commitments?
Yeah.
And, not only are the banks much less levered, they're probably 10 times more liquid.
Yes.
So all these companies pulled their lines, and the banks wrote checks like it was nothing. I mean, it had no impact on the banks at all. So I would say that the banks have come through this superbly.
Right.
I can't say the same thing for the bond markets.
Yes.
So as I like to say, and if we compare today versus the financial crisis, the banks are 1 for 2, and the bond markets are 0 for 2. And not only are they 0 for 2, it was worse this time. Because even during the financial crisis, you could always trade treasuries.
Yeah. And
prior to the Fed stepping in around March 23rd, 24th, or 25th, you couldn't even trade treasuries. Yeah. It was that bad.
So U.S. government bonds, some of the most liquid assets you'd imagine in the world.
Right. The only thing more liquid than U.S. government bonds is maybe the dollar currency.
Yeah, cash. Yeah.
Right. So I think major reforms are going to have to take place in the bond markets once once the coast is clear. That discussion hasn't even begun yet. But I wouldn't worry about it right now because the Fed is providing massive liquidity at the bond markets. The bond markets are functioning fine.
Yeah. So is that a systemic issue, though? Could that then have a knock-on effect to anything else?
Well, I mean, the issue is longer term, will what the Fed has done eventually cause inflation?
Yeah.
And at least in the near term, the answer to that question is definitively no. And again, a lesson from the financial crisis. When the Fed did QE and all its other stuff in 2009, 10, 11, and 12, there were a whole bunch of critics who said this is massively inflationary.
Yeah.
And it turned out not to be. And why? And the answer is when the Fed does QE, like they're doing now, what they do is they go out and buy bonds, and they basically go out and buy bonds from banks. And now banks have all this cash, and the Fed has the bonds. At this point, it's not inflationary because the banks are literally still holding the cash.
They're just hoarding it and keeping it to sort of buff up, strengthen their capital.
They would lend it, and that's when it would become inflationary. But if there's no loan demand, it can't be inflationary. So, during post-financial crisis, there was very little loan demand. So yes, the banks had all this cash, but they just sat on it. In fact, they give it back to the Fed in terms of reserves.
So could that be different this time then, do you think?
Well, I think it would be inflationary only if and when the economy really starts to pick up and that money starts to find its way to the system, which obviously is not the problem that we're facing right now.
Yeah. So you mentioned US banks being much stronger,
Yes.
but I think you alluded to perhaps it being a different case overseas.
Yes. I think with the exception of the Nordic banks, and a few, maybe of the British banks, the banks in Europe are still impaired. They're less levered than they were, but they're still a lot more levered than U.S. banks. I could probably talk about this for the next 2 hours. And people literally pass out into a coma.
Yeah.
So just take it from me. The European banks, they're better. They're not as good as the U.S. banks. And you know that because what you've experienced is what's called regulatory forbearance in Europe. Meaning, and I won't go into the details, but there's certain things that the banks were supposed to do this year and next year. And the regulators said, forget about it.
Yeah.
Or as we sometimes say in New York, forget about it.
Yeah, absolutely.
And there's been no regulatory forbearance in the United States.
Okay, fair enough. So, we talked a little bit about some of the bubbles we might have seen in the financial system previously. So you're not, are you worried that there are bubbles appearing in some parts of it? Obviously, we talked about the bond market, but that was more about liquidity, I think, than valuation.
The bond markets aren't bubble. They're being supported by Fed liquidity. So if the economy improves, that'll be okay. If the stock market goes a lot more, then I think there's going to be a bubble start to form in equities. But we're not quite there yet.
So are there any specific sectors, though, that you would avoid that you're going short within your funds that are betting that might go down?
I don't have any sector. I mean, the one sector that I have a little bit of what I call a sort of a short exposure in terms of the sector would be, I have a bunch of shorts in consumer staples because I'm sure you remember during the pandemic, basically everybody said, I'll go out and buy soup.
Yeah.
Or I'll go out and buy toilet paper. Or I'll go out and buy bleach. I don't have to tell your customers, exactly what I'm talking about.
Yeah.
I remember one day in New York, my wife says, go out and we need some paper towels. So I said, okay. So I go to the supermarket and I buy, like one of these huge packs of paper towels, and I put it on the register, and the cash register says to me, "You do realize this is costing you $38?" And I go, $38? Oh my God! So what was I going to do? So I bought the $38 worth of paper towels. But so I think there's a little bit of those stocks are overvalued.
So they've had a short-term boost to profits, but it's not necessarily going to last forever.
It's not. Look, we're not going to be paying $38 for paper towels.
I hope not. I hope not.
Me too.
But what does it mean really to go short a stock? So I think some people makes them feel a little bit uncomfortable, this idea of shorting
It
stocks.
does. I mean, I often get a question, what does it take to be able to short stocks?
Because you're profiting from failure, right? If a company fails, then you benefit. And
or
people
not
feel
just necessarily, it doesn't have to fail. It could do less well.
Yeah.
But regardless, you're rooting for the stock to go down, and not everybody is set up emotionally to do that. There's a wonderful German word called Schadenfreude, which it tells you a lot about German versus English, because in English there is no word that translates exactly for Schadenfreude, but what it means is reveling in the misery of others.
Yeah.
To be able to short stocks, and you got to have a little Schadenfreude.
Yeah. No, fair enough. Okay, so what about some of the areas that that you are a bit more positive on? So, looking at your fund, some of the top holdings are some of the big tech names. You've got Microsoft, Apple, Amazon. I think technology is probably your biggest long position in the funds. Certainly was.
Correct.
When I last looked. But those stocks, of course, grown amazingly quickly. Can that really continue? Are they maybe starting to look a bit expensive? How long can that go on?
I think the idea of, and this will I'll be completely honest, what does it mean for a stock to be expensive in a world where rates are zero is, believe me, not an easy question to answer. So my view is, for the Apples and the Amazons and the Microsofts of the world, in an age of disruption, you've got to have at least a certain percentage of your portfolio in those stocks. Now, you don't have to own the crazy high flyers because those things are so volatile. You might want to. I own one, which is Zillow, which believe I used to be short, and I covered it during the pandemic, and then a couple of weeks later, I turned around and bought it.
Yeah.
And the reason why I bought it was what I was hearing was housing was really picking up. And since people don't want so many people traipsing through their house to buy their house, they would use the internet a lot more. And so I bought Zillow for that sort of.
So Zillow is like an online estate agent, a real estate agent.
Correct. It's exactly. Yeah. I'm sure I forget the name. In the UK, you have that as well.
Yeah. Purple Bricks is one of the big ones here, for example. Yeah.
Same thing. Zillow is the biggest in the United States.
So, do you think the low bond yields and QE then are a real support for those big growth stocks? Is that one of the reasons to think that that they're still decent value even at these kind of levels?
Yes, I think that if the economy were to pick up, let's fast forward a year, 2 years, whatever it is, if the economy really picks up and the Fed then starts to raise rates, you're going to have to be a lot more careful in terms of your growth stock selection, because what's going to happen is the discount rate's going to go up, and the people may be more susceptible to selling those stocks and buying cyclicals.
And at that time, you want to bet more on cyclical stocks that might benefit from an economic recovery, I suppose.
Correct.
Yeah. So just on the technology theme, there was one a kind of a tech company really that you were short until recently, or fairly recently, I think, which is Tesla. So I remember reading an interview with you, and you said that it's kind of more like a cult than a company, and it's very, very hard to go short a cult.
Right.
What did you mean by that, and why were you short in the first place, and why did you change your mind?
Well, I was short in the first place because I felt that it would be difficult for various reasons for the company to grow up to expectations. In terms of sales, I was wrong. In terms of profitability, I think I'll probably turn out to be right. But given the fact that nobody seems to care about the profitability of the company, they just care about what the sales are. You're in a game where you're playing baseball and everybody's playing skeet ball, and you're concerned about X, Y, and Z, and the other team doesn't care about X, Y, and Z at all. And in a world where rates are zero and everybody can speculate to their heart's content, for that type of stock, it's best to get out of the way.
Yeah.
And so I got out of it many months ago.
Yeah. Actually, in one of these events, we've got one of the fund managers from Bailey Gifford, who are, I think, the second largest holder in Tesla. So, I mean, they backed it from, I think, right near the beginning. But if you were hosting that event, are there any particular questions you would ask them?
Yeah, I would ask them how they see the ultimate profitability of the company. How do they model that? How do they think about it? Because, I think at this point, you could say whatever you want, obviously, because nobody cares. But I'd be curious as to what they have to say about it, how much in depth they've really thought about it.
Yeah, sort of betting on it's either, I think it's a lot of it is whether or not you back Elon Musk or not, isn't it?
Correct.
Whether his genius outweighs his kind of
lunacy.
I didn't want to say it, but you can. So at that point, that's been fantastic so far. I think it would be good to take just a quick break, and I'll bring in my colleague Ben Rogers, and we'll see if we've had any audience questions on anything we've discussed so far. And then after we've talked about that, perhaps we'll then touch on the financial crisis and the Big Short.
Sure.
So Ben, hopefully you're there.
Hello, hi. Thank you for that, Steve and Mike. That was really interesting. We've had a few questions come in. Anyone, for our viewers, if you are watching, just remember there's a Q&A button at the bottom. So if you'd like to send in your questions, you can do so by that. I am reliably informed that if you're using an iPad, it's actually at the top of the screen, if anyone is looking for it. Steve, you mentioned a little bit there about the regulatory forbearance in banking, and I suppose I've seen some previous interviews where you've mentioned about the importance of the regulation in financial services. Also, I suppose going back to the financial crisis and the role the regulators played or didn't, for that matter, in the lead up. What do you feel the impact of President Trump has been on regulation in US banks so far, and I suppose also what impact do you think he may have in the future if he's re-elected in November?
That's a very good question. On the margin, the regulatory environment for banks since President Trump was elected has been somewhat more pro-bank. So, going back to Citigroup again, the company pre-crisis was levered 33-1. On the day that President Trump got elected, it was levered 10-1. And right now it's levered 12-1. So 2 turns more leverage. I would say that is a little bit more benign, but 12 is still a hell of a lot less than 33. So on the margin, more helpful. They loosened up the Volcker rule a little bit, but it's still pretty tough.
So does that mean that, the future sort of returns for banks will still be pretty low, maybe much more like in some ways, they're not the casino banks that they once were.
They're not even close.
Yeah.
The formula for banks, which applies to all companies, but it just makes a lot more sense for banks, is return on equity equals return on assets times leverage. So when Citigroup was levered 33-1, it had about a 1.2 ROA, return on assets. So its ROE 33 times 1.2 is like 35-ish%. When you got down to 10 times levered, the ROA was only 80 basis points. And so the ROE was only 8%, which is terrible. Yeah. Today, as the companies have levered a little bit more and taxes have gone down, the ROE is like 11, 12%, which is respectable. It's just not anywhere close to what it was. Yeah, thankfully, we don't want to go back to 35% ROEs.
No, but as leverage goes down, obviously that reduces risk, but it also reduces your future return as well.
Correct.
Yeah. Ben, are there any others at this stage?
Yeah, so we've had one from this is from A Nesbitt, who's viewing today, and it's getting a flurry of questions, so it's moving around the place. Obviously, I'm going to paraphrase slightly. Prior to obviously COVID and lockdown, the big question, I suppose, and the big uncertainty for investment managers was around the US-China trade tensions, separate to Brexit, which was perhaps more UK focused and European focused. How do you feel? So, do you hold any sort of Chinese exposure within your the fund, and how do you feel it will go between the US and China?
A great question. I mean, I have two positions that are, well, I own Alibaba. That's the only China name I have. And I also own Las Vegas Sands under a theory that Macau will reopen. But that's it. I think we are, regardless of who becomes president, whether it's President Trump or President Biden, I think we are in a Cold War with China of one form or another for the duration. I think that has massive long-term implications for industrial companies and consumer discretionary companies that have their supply chains in China. I think a lot of that's going to be moving either back here or somewhere nearer here. And the pandemic's going to accelerate that because people want shorter supply chains.
Okay.
Yeah, that's very interesting. What I'll do, I think we'll come back to audience questions in a minute, because I know we need to sort of finish by about 1:45. So I do want to just ask you, before we come back to audience questions, just a little bit about the financial crisis and about the Big Short. So, firstly, I suppose I would just ask you briefly, how did you kind of see what was happening in the housing market and the mortgage securities related market? Because and also then, reportedly you made, when it paid off, if you like, your bet on against those securities, you reportedly made around $750 million for the fund in that, pretty much overnight from those short positions. How did that feel, and how worried were you in the run up to it, that it might not pay off?
Let's see. I mean, there were two things that happened in 2006 that made me pretty as convinced as I could be that something bad was going to happen. The only question was how bad. So the first took place, I think, like in the first week of May, when a savings and loan, the largest savings and loan in the United States, called Golden West, sold to Wachovia. And that told me a lot, because Golden West was founded by a married couple called Herbert and Marion Sandler, who I actually knew personally. They were the best mortgage underwriters in the United States. The company had been in existence since the mid-'60s. They'd been through many, many ups and downs in terms of mortgages in California. It was largely a California company. And the fact that they were selling told me it's over. That was the first thing. And the second thing was just that, securitization data can be very illuminating, and it also comes out monthly. And what you began to see in the summer of 2006 was that the loans that were securitized in early 2006 were showing very high levels of defaults very early, much higher than prior securitizations. And so that just told me it was only a matter of time for the thing probably to blow up. The question was just how long it was going to take.
Yeah, so obviously you put in a big position to bet against it. As I said, it made a big profit for the fund overnight. But obviously that meant you were taking a big risk with the fund. So, I mean, how was that making you feel at the time?
I actually didn't think of it as that big a risk, because when I started putting on the positions, they were priced, I thought, very, very cheaply. So the way this works is, if you want to buy what's called a credit default swap on a tranche of subprime mortgages, it's like buying insurance. And so you pay a premium to the entity that you're doing the trade with. So let's say it's Goldman.
Yeah.
So I was paying on very, what I'd call risky tranches, only 3% of the principal. So, and that was going to be a 5-year piece of paper. So I didn't feel like I had a lot of risk at that point, because it was priced so cheaply, because people didn't seem to recognize what was coming. So, yes, the size of the position was big, but what it actually cost me to put on the position was actually very low.
Yeah. So like an insurance contract, obviously, if it hadn't paid off, all you lose is your premiums.
Correct. So I always knew that all I could lose was my premium, which I could always afford to pay.
Yeah. Interested. So how did it feel that time when you realized it had worked? Because obviously, I think it says, I haven't read the book, this was kind of shortly before that, you'd realise that actually this was quite a big systemic problem. It wasn't just, it was going to have a big impact to the US and the world economy and the financial system. So you kind of, on the one hand, perhaps elated that your trade has paid off. On the other hand, the world is falling apart, if you like.
So I would separate out between 2007 and 2008. 2007 was the year that I made a lot of money on the subprime paper. I made that against the Goldman Sachs's and the Deutsche Banks of the world. That felt pretty good.
So you profit at their expense, aren't you? Not against individual Americans.
It's a zero-sum trade. If you make $1, somebody loses $1. That's just how this works. So I felt pretty good making a lot of money against them. 2008 wasn't fun because 2008 I felt like Noah in the Ark. I'm Noah. I have an ark. My family is safe in the ark, and everybody's screaming outside. Believe me, Noah is not happy that people are screaming outside.
Yeah, that's a great analogy. I love that. And just coming on to The Big Short, so I always think it's a pretty brave move to turn a financial book, albeit a brilliantly written financial book, into a film, but it worked pretty well. What did you think when you originally heard there was going to be a film? And is it true that it was Brad Pitt who was originally meant to play the character based on you?
So the story was, I got a call. So when the book came out in 2010, the rights of the book were bought immediately by Brad Pitt's production company. And then nothing happened. And then I'd say in the late fall of 2014, Michael Lewis called me to say that I was going to get a call from somebody named Adam McKay, who had directed comedies up until this point. And Adam McKay had rewritten the script, and they loved it, and he was going to direct, and you'll get a phone call. And I'm like, yeah, sure, okay. And I talking to you, Michael. I thought it was nonsense. Then, sure enough, like a day or two later, Adam McKay called me, and he said that all what I just said. And then he said, and I want you to know there's a possibility here that Brad Pitt's going to play you.
Because that's what everybody wants, don't they? Is Brad Pitt to play them in a film?
No. To which I responded, listen, the only thing Brad Pitt and I have in common is we both have really good hair. I still have really good hair.
We've all got great hair after the lockdown.
But he couldn't do it, so Steve Carell, who did a great job, did it.
So how faithful was the book to what actually happened? And then obviously the film is a bit more of an adaptation. And actually the character based on you, obviously you asked for the name to be changed, I think, in the film. Why was that?
It's a personal reason. It's not important. I was just happy to have the name changed.
Yeah, fair enough.
But I like to call it plausible deniability.
Fair enough. But
I would say, there were some changes made in the movie for poetic license. Like if you might remember from the movie, Steve Carell has a brother who committed suicide. That's kind of like a backstory. I never had a brother. I have a sister. She's perfectly healthy. and as she always likes to say, not only did they kill me, but I wasn't even a girl.
Fantastic. No, that's really good. That's really interesting to hear. Thank you for that. So I think we'll just go back to Ben, and let's see if we've had any more. I think we've had a few more questions from the audience. So let's see how many we can get through in the next sort of 5 to 7 minutes or so.
Yeah, thanks again for that, Steve and Mike. Really, really interesting stuff. We have had a flurry of more questions. We will try and get through as many as we can.
But wait a minute, I can go till 11. It's fine. Go ahead.
Brilliant.
To the hour.
Excellent. Okay. So the next question came from looks like Ronnie. So going down the doomsday scenario, could this be a repeat, or could a number of repeats of this pandemic, by which I think he means second or maybe even third waves, cause a 1929 style depression rather than just a recession?
It's only 10:40 in the morning here in the United States. It's a little depressing this early in the day. I mean, sure, it's possible. I would say from a medical perspective, it's unlikely. And I'm no doctor, I'm no scientist, but what I've read is that, the doctors are getting better at treating it. So I think you would have to have for, A, recurrence, and B, massive mutation that made things a lot worse, which at this point, there's no reason to think that's going to happen. That a second wave could happen, obviously that's possible. But we're still in the first wave. We're not in the second wave.
Yeah, so you're not looking at planning ahead and going
as
down.
As my grandfather would have said, don't pray for bad times; they'll come anyway.
Yeah.
Although, Steve, you did tell me earlier you moved out of the city and you're now at Long Island. So is that kind of the theory of starting to?
Well, we're not going back. Like I said, the asset management business can function quite well with people working at home. So there's no point in me being in the city when I can be on Long Island. At least I can play a little golf after the market closes.
Yeah, absolutely.
Next question came from Norman, which is a great question actually. So, looking at your top holdings, you mentioned them earlier, the Microsoft, Amazons, and Apples. I suppose the only other one to mention there would be Google. It was the fourth to get to the trillion dollar club. I suppose stepping aside from the valuations, are there any concerns that the influence of these, I suppose, mega cap companies becoming too great? And what are your thoughts around antitrust pressures?
Yeah, it's a great question. So I used to be a lawyer, like in a previous life, but I have kept up on antitrust. I would say in a Trump administration, you may get antitrust investigations, but they'll be for show. In a Biden administration, I think you run a much bigger risk of real antitrust clampdown on some of these companies. I would say not Apple, but I'd say Amazon, Facebook, Google, those three, yes. So you might have to rethink those positions in a Biden administration.
And I suppose similar to the you mentioned earlier about I can't quite recall the company, but that you were quite comfortable within your fund going from what was previously a short position to covering the short to then actually buying in at a later date. As far as your sort of methodology or your approach to shorting and changing your position, would you ever sort of move more towards a potential sort of short position on any of those companies? Would there be a trigger for that, or?
The only way I would trade any of those companies if I really thought there was real serious antitrust risk.
Right. Yeah, and I suppose just in shorting in general, obviously with the risks that a short position can be theoretically unlimited to the downside.
Sometimes it's not so theoretical.
Yeah. What measures do you put in place to protect investors? Is it a predetermined level, sort of stop loss?
I don't have a predetermined level. I've wrestled with that my entire career. Like if I lose X percent, do I just get rid of it? But what I will do is make the position smaller, because think about it this way: you have the reverse problem on a short versus the long. So if you have a long, and let's say it's a 4% position, and unfortunately, the stock goes down a lot, so it gets cut in half, let's say. So now it's a 2% position. That's not fun, but when it's a 2% position, it represents a lot less risk to the portfolio. Now, if you have a 4% short and it goes up 100%, now you have an 8% short position. That's a massive risk. So one of the things that I will do is that if a short gets what I think is too large because it's going against me, I will shrink it.
Brilliant, thank you. Next question came from Barry. How difficult is it, in your opinion, for UK-based fund managers to run a successful US fund? Do you need feet on the ground?
I can't answer that question. I have no experience with it. I love the UK. I love to visit, but I just can't answer the question.
Well, I'll add a little bit to that from my point of view, because we find it's quite hard to find, particularly in the US, active fund managers that do consistently outperform the index. Do you think there is something about the US market that makes it perhaps harder than some other markets, it's more efficient in that way? Or in that,
I'm not necessarily more efficient. I think the ETFs and the indices, I think it's more zero rates. That in a world of zero rates, which we've had for now on and off for a very, very long time, active management is harder to outperform because questions of capital allocation become a lot more theoretical. I'm not saying it can't be done, but it's harder.
Yeah.
This was actually a question I came up with, but it was following what Mike's just said there about sort of active passive debate. Obviously, I suppose, sort of assuming it's the same in the US, but I suppose all areas of finance and investments are coming under more and more pressure on fees and costs. And one of the main criticisms of hedge funds in general and in the past has certainly been around the cost and the traditionally high fees in this part of the market. How do you approach cost, and how much added value do you really think you can add compared to lower cost trackers?
Well, I mean, look, if you just want to be long, you don't need me. If you want someone who can manage risk over a cycle, you could use me because I'm long and I'm short. In terms of the fees, I have done something very radical. So your typical hedge fund will charge 1.5% management fee and anything from 15 to 20% of the profits, plus expenses. So when they say plus expenses, if they hire a consultant to look at something, you pay for that. You pay for their Bloomberg, et cetera, et cetera, et cetera. So the 1.5% can very quickly become 2.5%, 3%, plus the 15 to 20% of the profits. I charge a fee of 1.3%, no percentage of the profits, and no expenses. So you just pay that 1.3%, plus I think a small admin fee of like 10 basis points, and that's it. So I think that's pretty fair.
Yeah. So almost, I suppose, aligning your needs with the needs of the investor as well. So you want their money going up as much as you do.
That's right. But I take no percentage of the profits, 0.
Brilliant. The next question we've got here is from Paul. So you mentioned earlier about the outlook for real estate agencies, particularly online, has been fairly positive. What's your outlook for property prices? Do you think they'll both move in line?
It's a great question. I think property prices in the United States outside of the cities will go up. You're already starting to see, for example, yesterday, Lennar, which is one of the stocks that I own, it's maybe the second largest home builder in the United States, announced a bang-up quarter. They beat the estimates by a lot. And one of the reasons was that they have pricing ability. They've been raising prices, raising prices. So I do think property prices are going to start to go up. Not crazy, it's not going to be like 2006 where people thought if you don't buy a house today, you're going to kill yourself. But they'll go up.
Brilliant. And this one came from Anonymous, which is
Hello,
original
Anonymous.
Name. Can you discuss the short Softbank position, please? Is this based on the Vision Fund, as the fund is also long Alibaba?
Well, yes, it's long Alibaba, but it's incredibly levered. I mean, look, we can talk about this for hours, but they have a lot of bad investments. They have a tremendous amount of leverage. It's a good position to have as a short, certainly against all of my technology longs. Companies that are very levered in a bad economic environment, and we still are in a bad economic environment, don't kid yourselves, can sometimes get into big trouble.
Brilliant. Couple of questions here. We'll try and get through as many as we can. So this one came from Brian. Are you concerned about the overstocking in many sectors, such as the automotive industry? And are some of these stocks overvalued?
What do you mean by overstocking? I'm not sure I understand.
Yeah, so I suppose my interpretation of that would be, you mentioned earlier about the stockpiling within the consumer staples. A large part of that, I suppose, is probably
well,
happening in other industries.
in autos, for example, there's very little inventory because there hasn't been any production. So, for example, you know, my wife and I recently bought a Jeep, you know, like as a summer car, and the dealer told us that basically the Jeep that we bought was like the last Jeep. It sounds like a movie, The Last Jeep. We bought the last Jeep, and there wouldn't be any more Jeeps until production started to ramp up. So, you know, there's no overstocking in autos, believe me. You know, whatever cars that are on the dealership that you see, that's it.
One of the questions again, so you mentioned earlier about 9/11, and I suppose one of the themes that came out of that was people moving out of the city. I remember from a previous event that our founder Colin Lawson hosted, he mentioned around, particularly in America, people started to drive more, and actually, given that driving is more, has higher fatalities than actually in aviation in general, that there was that shift towards driving in general. What's your opinion, I suppose, on investing in the aviation, and I suppose you could extend that to travel as well?
We have no positions in aviation, and we have no positions in travel other than Las Vegas Sands, which is really a play on Macau more than anything else. I honestly don't know what's going to happen to aviation and travel. I can only tell you that I have twin daughters who just graduated college. And as a graduation gift, we were supposed to go to Disney World. And they were graduating in late May. So we were going to go to Disney World, I think, like at the very, very beginning of June, which obviously got postponed. And we rescheduled it for August 15th. So call me back after August 15th, and I'll let you know what the parks were like. Because I have a feeling they're still going to be pretty empty. And we'll be wearing masks. So I don't know what's going to happen to travel. I really don't. But I'll have a better idea after I get back from Disney World with my girls.
Need to go and do some research.
I'm going to do some real hands-on research. Yes, sir.
Now, I suppose this is a question that's coming from Matthew. But I suppose within you mentioned earlier about the position of your fund at the moment is around 65% net long, and you mentioned that's about as long as you're able to go to. So this is obviously within the fund that you manage at the moment. You have limits of how long you can go.
Yes, the limit is 65%.
Yeah, you're a long short investor. But
right.
would you ever disregard that long short? Would you ever just go full long?
Well, the only way I could be full long is I'd have to eliminate all the shorts. Yeah. And then have only 65% of my capital in longs.
Yeah.
Otherwise, I'd have to go and change the fund documents, which is not pleasant.
Yeah. I suppose theoretically, outside of the actual fund, would you ever consider going, I suppose, full bullish?
Well, it's interesting. I have half my money. We also have a long only business as well. So in terms of what does Steve Eisman do with his personal money? Take my personal money, whatever it is, divide it in half. Half of it mimics the long-short portfolio, and half of it mimics our long-only portfolio. So this way, I have 100% skin in the game for both businesses.
And you have no bias,
which I think is fair.
And no bias from one to the other.
I don't have any bias.
Yeah, fair enough. I think from our point,
I don't have any bias. It's 50-50. If I had a bias, it's not too bright.
I think from our point of view, we'll always say, if you've got the risk tolerance for 100% equity, you can tolerate the ups and downs, and if you've got a long enough time horizon, then sure. But
right.
a lot of people don't.
So very much taking my interviewer hat there rather than my financial planner hat there, Mike.
Yeah, absolutely.
So we actually have, there's only one question left, which came in from Brian. You've touched on some of it, I suppose, throughout. He's mentioned about, the impact on not just, he's mentioned about the UK, but the impact on profits and I suppose the impact on the economy. I suppose the question I'll put to you is, with some of the sort of, I suppose, one of the notable separation almost between the economic data that's coming through and what stock markets are doing on that particular day. The one that I particularly remember was the day that they announced the unemployment figures in the US for March. It happened to be, I think it was a sort of 2-3% rise in the US stock market. What do you feel that the stock market, Brian's question is, the stock market doesn't appear to be recognizing the seriousness of some of the economic information that's coming through? So would you ever bet against it, or would, I suppose, you take a more selective approach?
I think it's hard to take a very negative view of the stock market right now, given free money. Like I said earlier, I think the only way to, at this point, to really have a very negative view would be to assume that in the fall we're going to have a real horrible second wave. Or I do think and I'm not making a political judgment, I'm just making a stock market judgment. I think if Vice President Biden became president and the Senate flipped Democratic, the stock market would take a very dim view of that, because they would notice that their taxes are going up, and you would want to be a lot more short at that point. A lot more short. Let me emphasize, a lot more short. One thing I know about people who invest in the stock market, and I'm not, again, I ain't making a political judgment about this. I'm just talking about I know the people who invest in the stock market. They do not like higher taxes. They don't care what the reason is. Those higher taxes could be creating, an economic nirvana. Doesn't matter. Just don't take my money. That's how they view it, and they take it very personally. Like I said, I'm not making a political judgment here. I'm just telling you, I know the people who invest in the market, they do not like it. They like lower taxes.
Yeah, absolutely. I know. Yeah, we know plenty of people like that as well. Just very briefly, if you did go short the market, how far could you go short? So you said you could only go 65 long.
I could be 20% net short.
Right. Interesting.
I have been slightly less than 20% net long in this fund at certain points. Being 20% net short would be a very dramatic bet.
Yeah. Well, Steve, thank you so much for your time today. I found it absolutely fascinating. It's been brilliant. So thanks very much, and hopefully we'll speak to you again soon.
Okay. Everybody be good and be safe.
Yeah.
Bye-bye.
Take care. And just from me, also to say just thank you to everyone for tuning in and watching us, and hopefully you enjoyed that, and hopefully you can join us again for a future live event. So take care. See you soon.